Here is a question that will change how you think about your paid-off home forever. What if I told you that your mortgage-free house is generating thousands of dollars of real income every single month income that is completely invisible on any financial statement, completely untaxed by the federal government, and completely uncounted in most retirement planning calculations? It sounds impossible, but the math is real. And once you understand it, you will never again underestimate the financial power of the home you own free and clear. The concept that unlocks the true financial value of a paid-off home in retirement is called imputed rent, and it is one of the most powerful and least discussed ideas in all of personal finance. Imputed rent is the economic value of the housing you consume by living in your own home rather than renting it from someone else. It is real income in every meaningful economic sense. It represents real goods and services you consume every single month that you do not have to pay for out of your retirement portfolio, and it is completely tax-free under current federal tax law. Here is how to calculate your personal imputed rent benefit. Find out what a comparable home in your neighborhood rents for on the open market today. In most American suburban markets, a 3-bedroom home with the characteristics of a typical retirement home rents for somewhere between $2,000 and $4,000 per month. In higher cost markets, that number can reach $5,000 to $8,000 or more. Whatever that market rent figure is for your specific home, that is the monthly income your paid-off home is generating for you in the form of housing costs you do not have to pay. A retiree whose comparable home would rent for $3,000 per month is receiving the equivalent of $36,000 per year in tax-free housing income from their paid-off home. To generate $36,000 per year in after-tax retirement income from an investment portfolio at a 4% withdrawal rate, you would need a portfolio of $900,000. Your paid-off home is delivering the equivalent financial benefit of a $900,000 investment account, and it appears nowhere on your retirement balance sheet. The imputed rent benefit compounds over a long retirement in ways that become truly extraordinary. If market rents increase at 3% annually, a conservative assumption that $36,000 annual housing benefit grows to approximately $58,000 by year 15 of retirement and $78,000 by year 25. The cumulative value of the imputed rent benefit over a 30-year retirement at typical market rent levels easily exceeds $1 million in equivalent purchasing power delivered entirely tax-free. Your paid-off home is not just a place to live. It is a tax-free income-generating machine that most retirement plans never properly value. The imputed rent calculation alone makes the paid-off home case extraordinarily compelling. But in Chapter 2, I want to show you how a paid-off home transforms your monthly retirement cash flow in ways that change every other financial decision you make. Imagine waking up on the first day of your retirement and knowing that the single largest monthly expense in most American household budgets, housing, is completely gone. No mortgage payment, no principal, no interest, no PMI, just property taxes, insurance, and maintenance on a home you own outright. What does that do to your monthly retirement cash flow? What does it do to how much you need from your portfolio every single month? The answer is so powerful that it literally changes the entire architecture of your retirement income plan. The average American mortgage payment in 2026 runs between $1,500 and $2,500 per month, depending on loan balance, interest rate, and market. For millions of retirees who have paid off their mortgage, that monthly obligation simply disappears on retirement day, creating an immediate and permanent improvement in monthly cash flow that has profound implications for every other aspect of their retirement financial plan. Let us run the numbers on what mortgage elimination actually means for retirement portfolio sustainability. A retiree who needs $75,000 per year to live comfortably with a mortgage payment of $24,000 annually embedded in that number needs their portfolio to generate significantly more than a retiree whose paid-off home has already eliminated that same expense. The retiree with a paid-off home needs only $51,000 from their portfolio annually to achieve the same lifestyle, a reduction of $24,000 per year in required portfolio withdrawals. Apply the 4% withdrawal rule to that difference. A $24,000 annual reduction in required portfolio withdrawals translates to a $600,000 reduction in the retirement savings target needed to sustain that income level indefinitely. A paid-off home does not just eliminate monthly payments, it permanently reduces the amount of investment capital a retiree needs to retire securely by hundreds of thousands of dollars. The cash flow benefit also creates extraordinary resilience during market downturns. When investment markets decline significantly, the retiree with a paid-off home has dramatically fewer mandatory monthly obligations drawing from their portfolio compared to a retiree still carrying mortgage debt. This reduced withdrawal pressure during market downturns is one of the most powerful protections against sequence of returns risk available to any retiree, and it comes entirely from the paid-off home rather than any investment strategy. The cash flow revolution created by a paid-off home also unlocks a psychological freedom that is impossible to quantify but profoundly real. When your housing is secured permanently regardless of market conditions, regardless of portfolio performance, and regardless of economic cycles, your entire relationship with financial risk changes. You sleep differently. You make better decisions. You hold your investments through volatility with a steadiness that retirees carrying housing debt simply cannot access. The cash flow transformation is real and powerful. But in Chapter 3, I want to show you the strategic options that a paid-off home unlocks, options that most retirees never even know they have. A paid-off home does not just give you financial security, it gives you options. Specific, powerful, financially significant options that are completely unavailable to retirees still carrying mortgage debt. Options that can generate additional retirement income, fund long-term care needs, help your children or grandchildren financially, or dramatically reduce your cost of living in ways that extend the life of your portfolio by years or even decades. In this chapter, I am going to walk you through 5 of the most powerful financial moves that only paid-off homeowners can access in retirement. The first powerful strategic option available exclusively to paid-off homeowners is the home equity conversion mortgage, more commonly known as a reverse mortgage. For homeowners over 62, a reverse mortgage allows you to convert a portion of your home equity into tax-free cash without selling your home, without making monthly payments, and without giving up the right to live in your home for the rest of your life. The strategic use of a reverse mortgage as a last resort income source or as a portfolio volatility buffer has been validated by serious academic financial research as a legitimate retirement income tool when used correctly by homeowners with sufficient equity. The second strategic option is the cash-out downsizing move. A retiree who owns a $400,000 home free and clear can sell that home, purchase a smaller, lower-maintenance property for $250,000 cash, and pocket $150,000 in tax-free capital gains proceeds, subject to the primary residence exclusion that can be invested to generate additional retirement income. This single transaction can add $4,000 to $6,000 per year in additional portfolio income, while simultaneously reducing property taxes, maintenance costs, insurance, and utility expenses. The third strategic option is geographic arbitrage, relocating from a high cost of living market to a lower cost market using the proceeds from a paid-off home sale. A retiree selling a home worth $600,000 in a high-cost coastal market can relocate to a lower-cost region, purchase a comparable or superior home for $300,000, and bank $300,000 in portable wealth that transforms their retirement financial position entirely. The fourth strategic option is the rental income strategy. A paid-off home gives its owner the option to rent out a portion of the property, a basement suite, a garage apartment, or a second bedroom generating monthly rental income that supplements Social Security and portfolio withdrawals without requiring any capital investment beyond a home they already own. The fifth strategic option is the multi-generational living arrangement, allowing adult children or other family members to share the paid-off home in exchange for financial contribution or caregiving support in a way that benefits all parties across multiple generations. Options are wealth, and a paid-off home is one of the richest sources of retirement options available to any American retiree. The strategic options are extraordinary, but in Chapter 4, I want to address the argument that most financial advisors make against paying off your mortgage and show you exactly why that argument is far weaker than it sounds. Almost every financial advisor who has ever discussed paying off a mortgage has said some version of the same thing. Why pay off a 3% mortgage when you can invest that money and earn 7 or 8% in the market? The math is obvious, they say. Keep the cheap debt and invest the difference. And on paper, that argument looks completely airtight. But there are 5 things that argument consistently ignores, 5 factors that, when properly accounted for, make the pay off your mortgage conclusion far more defensible than the investment community wants you to believe. The invest instead of pay off argument is a staple of financial advisor conversations, and it is built on a mathematical framework that looks compelling in a spreadsheet, but consistently fails to account for the full reality of human financial life in retirement. The first thing the argument ignores is risk-adjusted returns. The 7 to 8% average annual stock market return is not guaranteed. It comes with significant volatility, including years of negative 20, 30, and even 40% returns. The 3 to 4% guaranteed return from paying off mortgage debt is risk-free and certain. Comparing a guaranteed return to a volatile average return without adjusting for risk is a mathematically incomplete analysis that systematically overstates the investment case. The second thing the argument ignores is behavioral reality. Most Americans do not consistently invest the difference between their mortgage payment and what they would have paid extra toward principal. Studies consistently show that money not committed to a specific obligation tends to expand into lifestyle spending rather than investment. The forced savings mechanism of mortgage payoff is a behavioral feature, not a bug. The third thing the argument ignores is the tax situation in retirement. The mortgage interest deduction becomes less valuable in retirement when income drops, and the standard deduction often exceeds itemized deductions. The tax benefit that made carrying mortgage debt attractive during high-income working years often disappears entirely in retirement. The fourth thing the argument ignores is sequence of returns risk in retirement specifically. During the accumulation phase, a long time horizon absorbs market volatility. In retirement, simultaneous withdrawals and market declines create permanent portfolio damage. A paid-off home dramatically reduces mandatory monthly withdrawals and therefore dramatically reduces sequence of returns exposure during exactly the years when it is most dangerous. The fifth and most important thing the argument ignores is the psychological value of certainty. The peace of mind that comes from knowing your housing is permanently secured regardless of what markets do has real financial value. It produces better investment decisions, lower stress-related healthcare costs, and better long-term retirement outcomes in ways that a simple spreadsheet comparison between mortgage rates and expected returns completely fails to capture. The invest instead argument is not wrong in every situation, but it is presented as universally correct when the reality is far more nuanced. The counter-argument examined. Now in the final chapter, I want to give you the complete strategic framework for maximizing the value of your paid-off home in retirement starting right now. You now understand why a paid-off home is one of the most powerful assets in retirement. You understand the imputed rent benefit, the cash flow revolution, the strategic options it unlocks, and why the arguments against it are weaker than they appear. Now it is time to talk about action. Because owning a paid-off home in retirement is only the beginning. The retirees who generate the maximum value from this asset are the ones who think about it strategically, plan for it deliberately, and treat it with the same intentionality they bring to every other major retirement decision. Here is your complete maximization framework. The paid-off home maximization framework has 5 strategic layers that work together to extract the full value of this extraordinary retirement asset across every phase of your retirement life. Layer 1 is accurate valuation. Most retirees dramatically underestimate the true value of their paid-off home in their retirement financial picture. Complete a full imputed rent calculation for your specific home using current market rental comparables in your area. Add that annual imputed rent value to your net worth statement as a recurring income equivalent. Add the current market value of the home as a balance sheet asset. Update both numbers annually. When you see your paid-off home properly valued on paper, it transforms how you think about your overall retirement financial position. Layer 2 is strategic maintenance and preservation. A paid-off home that is allowed to deteriorate loses both its imputed rent value and its strategic option value simultaneously. Brilliant retirees treat home maintenance as a non-negotiable financial priority, not an optional expense. A well-maintained home preserves all 5 strategic options we discussed in Chapter 3. A deteriorating home loses them one by one as repair needs mount and market value declines. Layer 3 is property tax management. Property taxes are the largest ongoing cost of a paid-off home in retirement, and they can grow significantly over time in appreciating markets. Research every property tax relief program available in your state and county, including homestead exemptions, senior citizen relief programs, veteran exemptions, and income-based property tax freezes. Many retirees are eligible for significant property tax reductions they never claimed simply because they never researched what was available to them. Layer 4 is estate and legacy planning integration. Your paid-off home is likely one of the largest assets in your estate. Work with an estate planning attorney to ensure it is titled correctly, integrated properly into your overall estate plan, and positioned to transfer to your heirs with maximum tax efficiency. A stepped-up basis at death can eliminate capital gains taxes on decades of appreciation, a benefit worth tens of thousands of dollars to your heirs that requires deliberate advance planning to capture. Layer 5 is the exit strategy plan. Every paid-off homeowner should have a clearly defined decision framework for the 3 most likely exit scenarios: staying in the home through the end of life with aging-in-place modifications, downsizing at a specific age or trigger event, or transitioning to a continuing care community. Having this framework defined in advance rather than making crisis decisions under emotional or health pressure produces dramatically better financial and personal outcomes. Your paid-off home is your retirement superpower. Treat it like one. If this video gave you a completely new appreciation for the value of your paid-off home in retirement, hit that like button right now. Subscribe to this channel because every single week we bring you retirement education this deep, this specific, and this honest. And share this video with someone who is working hard to pay off their mortgage, because what they are building is worth far more than they know.